attorney. So he'll be able to answer any questions we have and present some good information to us. So with that, it's up to you. Okay. Do you want this or not?
Sure. All right. Thank you, Diane. Well, good morning, everyone. My name is Scott Lowy, as Diane mentioned, with Savant Wealth Management here in town, and I appreciate the opportunity to come to visit with you today. I apologize, I didn't expect we'd have such a great turnout, so I only have about 25 copies or so, but if anyone wants more copies of the handout, we can coordinate with Diane and get more copies to you. The handout is also the same that's up on the screen, so we'll be kind of following along that for our little presentation today. So as Diane mentioned, Scott Lowy with Savant Wealth Management. I've been in the financial industry services business since 1991, so there isn't a whole lot that I haven't seen. I am a recovering attorney, so we'll be more than happy to answer any questions that you might have today. I understand we have about 20 minutes or so I'm going to tee up a number of items. If you have any questions, I'd be more than happy to stick around later, or if you think of something in the middle of the night that you wish you would have asked today, forward the questions to Diane and she'll make sure that she gets them to me. So with that, our agenda today, I'm going to tell you a little bit about Savant. Don't want to take for granted of what you may or may not know about us and how we already have a relationship with Court Street. I want to talk a little about the Tax Cut and Jobs Act of 2017. And the reason why this was an important piece of legislation that impacted all taxpayers, particularly those who might have some charitable inclinations. And then we're going to dive in and talk about some tax smart strategies and some thoughts for you to consider. Then again, we can open it up for questions and answers. All right, so next slide, please. All right, next slide. All right, so a little bit about Savant. Savant is Rockford homegrown. Global world headquarters are right behind Lowe's here in Rockford, Illinois. And as you can see on Savant at a glance underneath, we used to manage about $13 billion of people's hard-earned money. It's now about 12. And it's individuals and it's foundations and endowments and it's 401k plan. And the nice part is we have close to 300 employees now. We kind of fly under the radar screen, and we have no products to sell, but we've got a lot of really smart people that I've surrounded myself with, and we're able to do presentations and share intellectual capabilities with groups like you today. On the far right-hand side, we now have 24 locations. Again, global world headquarters right here in Rockford, Illinois. We were born on Auburn Street. We moved to State and Prospect, you might recall, and now again we're right behind Lowe's. So our main geographic footprint is right here in the Midwest, but we have an office out in McLean. We have an office in Arizona, in Scottsdale, and New Mexico, and we're expanding into Iowa and Michigan and Indiana as well. So it's really a great success story. All right, next slide, please. All right, I mentioned earlier that there was some pretty major legislation that was passed at the tail end of 2017 that became effective January 1st, 2018. So what this tax act did, it actually, for taxpayers, it had a lot of benefits. And the first one, of course, you may recall, is that it doubled the standard deduction for all of us. In other words, it used to be if you were married filing jointly, you would be able to deduct $12,000 off of your income to arrive at what was called taxable income. So that's what the rules used to be, but this tax act that was passed actually doubled it to $24,000 starting in January of 2018. And the reason why that's important is because that actually had the impact, as that the third bullet point shows, is that many people no longer are itemizing their deductions. Remember, as a taxpayer, you can take the greater of the standard deduction, the amount that the IRS is going to give you to deduct against your income, or you can itemize your deductions, and if that dollar amount is greater, you would deduct that from your income. So what goes into those itemized deductions? Well, there's some medical expenses if they exceed a certain percent of your adjusted gross income. There were the taxes that you would pay. Now, this legislation kind of curtailed, this was the taketh away part of this legislation, whereby the state taxes that you paid and local taxes and real estate taxes, is now capped at $10,000. So if you have real estate taxes of $5,000 and maybe you made state of Illinois income tax either estimated payments, or if you're still working those monies that came out of your paycheck for state withholding, and any other sales tax that maybe you paid, if it exceeded $10,000, this legislation capped it at 10. So that was a little takeaway for the tax-paying public. Those are called the SALT limitations. You might have heard about them last summer with that Build Back Better Act that was being proposed. A lot of the high income tax states were looking to trying to eliminate that provision, but it did not happen. Then the last bullet point, or the next to the last bullet point, you can see that this tax act also had the impact of greatly reducing people's charitable donations that would then be taxable. And why is that? Because that standard deduction was doubled. Now there was some legislation that was passed. It was called the CARES Act, and we'll talk about that in a moment. But all of this legislation that was passed as part of this tax act that actually reduced tax rates for all of us as well. Remember, the 15% tax bracket went to 12. The 25% tax bracket went to 22, the 28% tax bracket went to 24. So there were a lot of benefits for taxpayers in this act, albeit it had some pretty major implications for charitable giving going down the road. Now what's interesting about this tax act is that it's scheduled to sunset on December 31st, 2025. So if Congress does nothing, and a lot of people say Congress does nothing all the time, we will automatically, without any legislation, revert back to the old rules that were in place back in 2017. So stay tuned and we'll see how that all shakes out. All right, next slide, please. Okay, a lot of words on this page, but there was a fair amount of impact on charitable giving that this tax act had. But what's also interesting is that, as you can see in that top bullet point, charitable giving continues to be very strong with the U.S. public. Over $45 billion was donated to charities for the 12-month period ending June 30th of 2022. And you can see in the second bullet point, gifts were actually down in Q2, the quarter ending September 30th. But when you take a look at year-over-year numbers, you can see that the numbers were up 8.5%. What you might find interesting is when we dig down into some of the sectors, for instance, faith-based organizations actually had a 6.1% overall year-to-year increase in the donations that were given. And to put this in perspective, the average donation in 2021, according to the study, was $348 per donor. You might find it interesting that the largest three growth in annual giving has been in the human services area, environmental concerns and projects, and then followed by animal welfare. But what's also interesting, and this gets back to that legislation, that tax act had a tremendous impact on those folks who are able to itemize. The folks who used to itemize was 46 million, and it dropped down to 19. So pretty dramatic impact on all of our tax returns. All right, so next, let's talk about some tax smart strategies. So there's 5 top strategies that I just wanted to tee up, and the one in the middle we're gonna spend most of our few minutes talking about today. So there are a number of different ways to get monies into charities' hands. Some are more tax efficient than others. So on the far left, of course, you get the, and this came yesterday in my mailbox. You know, we're getting close to, you know, every organization, you know, you're on their mailing list, and it's very easy to give cash. You can go to your checkbook, you write the check. It's very simple. You send it in, you get the nice notice back, thank you very much. And normally you take that receipt and put it in the shoebox and give it to your tax preparer. So that's one way, of course, to make a charitable contribution. But remember, I shared with you earlier that so many people, less people are itemizing these days, so you might not get a tax benefit for that cash contribution that you made. Not that you would give for a tax deduction, of course, but all things being equal, it's kind of nice to get that additional benefit. But that's not the most tax efficient way to get monies into charities' hands, because remember, you earn the money, paid tax on it, now it's in your checking account, and you're actually making that contribution with after-tax monies. Okay? But again, it's very simple. Another way to do it, non-cash giving, if you have some securities that have appreciated in value, say you bought a share of Apple computer for $100 and it grew to $150, you could pick up that one share of Apple, transfer it over to Court Street United Methodist Church. You would get a charitable deduction for the value, $150 in my example, and the $100 that you paid for it, that $50 of unrealized gain, poof, goes away for federal and state of Illinois tax purposes. So that's a much more tax efficient way to, again, get monies in charities' hands. You eliminate any unrealized gain. So said differently, if you would have sold that one share of Apple and then decided to give the church the $150, you would still have to pay tax, capital gain tax rates, on that $50 of appreciation in my example. So again, much more tax efficient to donate the shares in kind, simply have it transferred from your brokerage account to the church's brokerage account. All right, we're going to skip over 3 for a moment. Charitable trusts. These are a little more sophisticated techniques, a little beyond the scope of our conversation today, but they've got all kinds of acronyms called GRITs and GRATs and CLATs and donor advised funds. And again, it's a strategy whereby you can make a contribution. Sometimes you can receive income for a period of time. There are others where the charity gets monies right away, and then eventually when you pass away, you're able to pass on those monies to your heirs. So again, a little beyond the scope of our conversation today, but know that there's some other strategies out there as well. On the far right-hand side, estate planning, think about your will, think about your trust. Quite frankly, for tax-qualified monies, monies that came out of a 401k or IRAs, those are wonderful sources, buckets of monies that you have to give to charity. The reason why is when you made the contribution, it was typically done on a pre-tax basis, so you got the immediate tax benefit. It grew tax deferred over time, meaning you never paid any tax on any earnings, any income, any interest, any dividends, any capital gain distributions. And then eventually when the monies come out, if it goes to charity, the beauty is no tax consequences to you. So again, a very efficient type of strategy. If you have charitable inclinations, maybe you name the church or your favorite not-for-profit organization as a beneficiary of your 401k or your IRA. All right, that middle box, qualified charitable distributions. So what is this all about? A number of years ago, and this has been kind of slow to catch on, but there isn't a week that goes by where we're not having this conversation with our clients. So it's becoming a very popular avenue to help get monies from you to the church in a really tax efficient manner. So let me kind of tee up what some of the rules are. All right, so if you have an IRA, or maybe you had a 401k that you transferred to an IRA, and you're over the age of 72, the IRS says it's time to get even with us. You've enjoyed the tax benefit when the monies went in, you haven't paid any taxes along the way. So when you reach age 72, you're now required to take monies out. It's called required minimum distributions, whether you want the monies or not. IRS doesn't care what you do with it. All the IRS cares about is that it leaves your IRA. When that happens, you then report that dollar amount as income on your current year's tax return, and is taxed at ordinary income tax rates. You don't get preferential capital gain or qualified dividend tax rates. It's taxed at ordinary income tax rates. So to a certain extent, it's a little tax nasty. Now, what the IRS will allow you to do in that third bullet point is you can make what's called a qualified charitable distribution. So how that works is you elect to have the monies come out of the IRA, get sent directly to the charity of your choice. the monies don't go into your checking account. The check is made payable to the charity. And if you do that, you don't have to include that amount in income and pay tax on it, and it counts towards that required minimum distribution. Okay? Don't include it in income. You get the charitable benefit, and it counts towards your required minimum distribution. Now, a couple things. Next slide, please. All right. So again, if you don't itemize, what a great strategy, because these monies that go to charity are not includable in income. Now, you don't get a charitable deduction for it. You can't have it both ways. You don't get to exclude it from income and also take a charitable deduction. But more often than not, you're better off excluding it from income to begin with. So the rules are, under IRA to charity, the IRS has a dollar amount. They say no more than $100,000 per person in any 1 year can be donated to charity through this method. So clearly a large dollar amount. You can do all or a portion of your required minimum distribution, or you could even contribute more than your required minimum distribution. Well, why would somebody potentially want to do that? Remember that required minimum distribution dollar amount that you have to take out every year there's a calculation, and the formula is whatever your market value is on 12/31 of the end of the year, that determines what your required distribution is going to be for the subsequent year. So obviously if the monies go to the church, for instance, that's going to reduce future years' required minimum distributions. Again, I mentioned that it's excluded from income. There's no itemized deduction. And again, you got a tax benefit when the monies went in, never paid any tax along the way. Now the monies come out income tax free to you, the taxpayer. Now that last bullet point down at the bottom is kind of an important one. If you want to take advantage of the strategy, the custodians, the brokerage houses that hold the money that you've instructed to send the check made payable to the charity, they don't report that to you. So in January, February of the following year, you get what's called a 1099-R form. It looks much like a W-2. That's what you bring to your tax preparer, and it says on that form, what's the gross distribution from the IRA? And then there's a little box that says taxable amount not determined. So if the gross distribution is $25,000, and let's say you gave $5,000 to the church, you only need to report $20,000 on your tax return, in my example, but that form doesn't specifically say that. So you've got to make sure you mention that to your tax preparer to make sure that those monies that went through this qualified charitable distribution strategy are indeed excluded on your tax return. Again, the custodian's not going to report that for you. All right, a few nuances. We get the question sometimes, I have an inherited IRA. Can I make these qualified charitable distributions out of inherited IRA? So what's an inherited IRA, first of all? So let's say your spouse named you as primary beneficiary, 100% of my IRA. If they were to pass, that IRA could be treated as an inherited IRA. Or maybe if you have kids and you pass away, you named your kids as the primary beneficiaries, and if they have an inherited IRA, they can also take advantage of this strategy. However, in order to do so, you need to be age 70 and a half. So there's an important distinction with these qualified charitable distributions. Even though the required minimum distribution now doesn't kick in until age 72, you actually can take advantage of these qualified charitable distributions if you're age 70 and a half. Remember, the old rules used to be 70 and a half. That's when you had to take the monies out. Well, recent legislation changed that age to 72, but they didn't pick up and make the qualified charitable distributions necessarily match age 72. So again, this strategy is for folks who have those IRAs, who need to take monies out after age 72, but you can also do it after age 70 and a half. We get the question sometimes, can I contribute these monies to what's called a donor advised fund? And the quick answer is no. And this was probably an oversight by Congress, because a donor advised fund is a 501c3 tax exempt entity anyway. But for some reason, you're not allowed to take monies out of your IRA, donate it to your donor advised fund, and still get the tax treatment of it not being included in income. So a little important but significant distinction. Remember, the check is made payable directly to the charity. It's not made payable to you. So you would inform your custodian to make it payable to Court Street United Methodist Church. Now, the check can be mailed to you to the home address on record, and you can write the nice little note, or you can drop it off in the office. But the point is, again, the check is not made payable to you. It's made payable directly to the charity, the not-for-profit organization. So I mentioned earlier, one of the additional benefits is, anytime you can exclude items of income, that tends to be a good thing. And it has other ramifications besides just income tax brackets. So for instance, Medicare premiums. The amount of your Medicare premium is actually based on the amount of your income 2 years ago. Okay? So there's this 2-year look back that will dictate the medical premiums that you pay, and it looks back 2 years. So again, if you can reduce your income, that might have the impact of dropping you into maybe a lower Medicare premium threshold. Congratulations, by the way. You've probably heard Social Security. Everyone's getting a raise who's collecting Social Security. 8.7%. Bump that everyone's going to get January 1st in Social Security benefits. And remember, that's on top of a 5.9% increase last year. So congratulations, if you're in that boat, everyone's getting a raise. Interestingly enough, the Medicare premiums, which tend to go in lockstep and tend to be close to the same increase in the Social Security benefits, I'm glad you're all sitting down. The Medicare premiums have actually been publicized that they're going to drop by about $5.20 a month. Very surprising to me, because if you've checked lately, inflation is running pretty hot these days. But anyway, there will be a reduction, albeit small, in your Medicare premiums starting January 1st as well. All right, Social Security taxability. For folks who receive Social Security benefits, there's actually 3 different thresholds by which you need to include those Social Security benefits in your income and pay tax on it. So there's 3 brackets. One is 0. 0 is pretty good last time I checked for folks who are in a relatively low income tax bracket. Then it jumps to 50%, meaning you have to include 50% of your Social Security benefits in income and pay tax on it. And then the last tax bracket for married filing jointly folks that might have $44,000 or more of other income, 85% of your Social Security benefits are includable in income that you have to pay tax on. So again, the thought there is, if I can reduce my income by taking advantage of these qualified charitable distributions and take it out of the IRA, that might drop you into a lower Social Security threshold taxability bracket. Medical deductions subject to 7.5% of your AGI, your adjusted gross income. Again, same concept. If you can reduce your income, chances are you might be able to deduct a few more of those medical-related expenses on your Schedule A itemized deduction form. Roth conversions, we're big believers in that whole Roth concept, whereby people can have a bucket of monies that they can potentially access income tax-free going down the road. For some people it makes great sense, others just so, and others no. We need to look at that on a case-by-case individual basis. But again, if you're reducing your income by taking advantage of the qualified charitable distributions, that might afford an opportunity to maybe get a little more aggressive on the Roth conversion side. There's also a 3.8 investment income surtax. So think for high income earners or folks who have high income as reported on their tax return, there's an additional surtax on qualified dividends and capital gains. If your income is over a certain threshold, again, the thought is if you can keep it below that threshold, that would give you a better tax result. And again, qualified dividends and long-term capital gain tax rates, there's a couple different tax rates for those as well. There's a 0% tax rate, again, pretty good. Then it jumps to 15 if your income falls within certain ranges. And then for higher income earners, the qualified dividends and long-term capital gain tax rates jumps to 20%. So again, it's all in an effort to try to keep your income down. It's a wonderful strategy. It helps satisfy charitable inclinations for folks. So again, rather than going to your checkbook and writing a check to the church, if you have an IRA, visit with your advisor to see if it makes sense for you. Chances are it probably does. So a little more effort on your part, but again, better tax result come April 15th. So with that, I've done all the talking. And that concludes my prepared comments for today. I understand I'm between you and the Family Fall Festival, so I apologize. But if there's any questions, I'd be more than happy to take them. And if you want to visit afterwards, I'd be more than happy to answer your question as well. All right, ladies first. Diane. Yes, the question is, can I give an example of non-qualified charities? Okay. In the not-for-profit world, there are organizations called 501c3 organizations. That is the vast majority of churches, vast majority of the organizations that we all know and love and that we hear of all of the time, the vast majority of not-for-profit organizations in Rockford. Now, to make sure that this qualifies under the charitable distribution rules, you could call the charity and ask if they're a 501c3. Most likely they probably are. So it's the Salvation Army, it's the churches, it's Carpenter's Place, it's the Rescue Mission, it's United Way.
In the case of Court Street, you call Laurel, she gives you the tax number. And then sometimes custodial organizations want to know the actual the charitable number, and so you give it to them straight away.
Look at that, we'll make it as easy as possible, right? It's not required, at least on the forms that we have. The form that the IRA account holder signs, they tell us the name of the charity, they tell us the address, they tell us whose attention to send it to, and then frankly, it's pretty easy and goes from there.
The other thing that I found really helpful, if you depend upon your IRA to give you a flow of money, if you go ahead and have them calculate, or you calculate out what your year's income will be for the next year, and you take that out, and then have them just distribute the money that's left, you don't wind up with uneven income monthly. And it may make it easier to just have a cash flow during the year.
Thank you. Colleges and education institutions, I should have mentioned as well, because typically they qualify under that non-taxable, not-for-profit organization. Yeah, the question is, what about the Elks Club? I'm not sure. My initial inclination is that they are not.
The organizations that don't are the organizations that lobby, organizations like Nature Conservancy, or organizations like that try to get the government to do certain things by lobby. So those kinds of organizations usually don't have enough.
So again, a quick Google search would probably answer that question for you, or again, you could actually call the organization yourself and ask them that question. Yes, sir.
The agreement with the IRA or whatever is giving your minimum distribution, does that have to be made open next year?
Okay, so I think your question is, yeah. So I think the question is, during what part of the year do you need to make that qualified charitable distribution? Okay, an important but subtle distinction. Remember I mentioned earlier that you can take advantage of this strategy when you reach age 70 and a half. However, if you're going to make the qualified charitable distribution, it has to be after you reach age 70 and a half, not the year you reach age 70 and a half.
But how does making that decision with wherever you're invested in, how does that affect where you decide to instruct them during the calendar?
It doesn't. You can make the decision. You can tell your provider on January 2nd you want to kick monies out. Great. You can wait till the end of the year as well. But if you're going to wait till the end of the year, I would caution you, make sure that there's plenty of time for that check to get cut, sent to the organization, and make sure that it gets cashed prior to December 31st. Okay? But really, you can do it any time during the year. Yes?
Whatever it is, ruling from 2017, it's the sundown in 2025, does that have anything to do with the period of time?
Right. So the question is, when this act that was passed at the tail end of 17, does that have anything to do when it sunsets, specifically as it relates to charitable contributions? Yeah, it does. The reason why is that doubling of the standard deduction that we've enjoyed up until the end of 2025 is going to get cut back in half. So therefore, that would probably have the impact of a lot more people being able to itemize. They would then be able to take potentially a charitable deduction on their Schedule A, whereby maybe they haven't been able to for these interim years. So it might have an impact on a number of folks. Remember I shared with you that the number of people went from 40-some million who itemized down to 19. That was a direct result of that legislation. So if that goes away and we go back to the old rules, then I would suspect that there will be a lot more people that will be able to itemize, take a tax deduction for the charitable contribution. All right, isn't this fun? Taxes on a Sunday afternoon. Yes, sir.
How small a distribution have you come across that you've been eager to support? Because sometimes people write checks for $10 or $20 or whatever.
Yeah, great question. So the question is, how large does the check have to be, or can we do them for really small dollar amounts? The IRS doesn't care. Okay, but we do, that's right, because the way that we're currently set up is if you want to donate monies to the church, let us know. We'll complete the form for you, make it signature ready. We'd like to have $250, $500 as a minimum. Now, we also understand that there's lots of folks that like to contribute $100 to a number of different charities. All right, you didn't hear this from me. We have the ability to give our IRA clients a checkbook whereby they can write checks out of their IRA and it goes directly to the charity of their choice whenever they want. All we ask is for, let's keep the communication lines open, because typically we don't hold cash in your IRA when it doesn't pay anything, and don't pay us to manage cash. So if you're going to make any large contributions, let's make sure that the monies are there, whereby we would sell the asset, collect the proceeds, hold it in a money market account, and then you can go write your $100 check. So there is a workaround, but again, we've got to keep those communication lines open. So bottom line to the question is no, that there's no de minimis dollar amount whereby if it falls below, you can't make that contribution. Yep. Okay, last question. Thank you. Are you referring to a donor-advised fund? Okay, so a donor-advised fund, if it's in the name of both of you or just one of you and that person passes, there's always a line of succession in the donor-advised fund agreement where you have named a successor owner whereby they would then step into your shoes and make those charitable distribution decisions. Well, again, I thank you for sticking around. Enjoy your family fall festival. Yes, thank you. And again, I'll stick around for a few minutes later to answer any questions. Yes. Thank you, Steve.